What's up, everybody? My name is Joe Brown. This is Heresy Financial. Today we are going to talk about what I consider to be the day that capitalism died. This has to do with the rise and fall of a hedge fund called long-term capital management, and the intervention that was done to prevent the complete meltdown and failure of that hedge fund, in my opinion, planted the seeds and it started the death. That was the day capitalism started to die in the United States. Ready? Let's dive in. If you've never heard of long-term capital management, don't worry, not a lot of people have. It was a hedge fund that was started and run by two Nobel Prize winners. Myron Scholes and Robert Merton. They won the Nobel Prize in economics for developing the Black-Scholes options pricing model. So these guys were smart guys. They weren't dumb. However, they did almost take out the global financial system. So here's what happened. This hedge fund, they engaged in trades that I will describe as relative value trades. So imagine, they didn't do this with stocks, they did it with like currencies and bonds, but this is the best way to understand the types of trades they were engaged in. Take a stock like Google. There are two share classes of Google stock. There's Class A and Class C shares. The only difference between these two shares is one of the classes of shares has voting rights, the other one does not. So because there's only a difference in voting rights, the percentage that these stocks move is always almost identical. It's never exactly the same, but it's very, very, very close. So if you wanted to take advantage of certain times when the prices diverged from each other and then close out that trade and profit off of them coming back together, what you would do is you would sell short the one that is higher and buy long the one that is lower. Now, what's going to happen is that these two are going to, for the most part, move together, right? So when they both move down, your short is going to profit, your long is going to lose, and then when they both move up, your long is going to profit and your short is going to lose by offsetting amounts, right? But every once in a while, when those two prices diverge too much, well, they're going to come back together. And so it's an arbitrage play. You're shorting one thing and buying another that in general move pretty much identical to each other, but you're going to enter into that trade when they're really far apart and then close that trade when they get closer together, taking advantage of the relative difference in value between the two. Relative value trades. Now, they didn't do this with stocks like Google. They did this with currencies and bonds. But because it worked so well and because based on their Nobel Prize winning pricing models, they were able to look at this and say, hey, this is risk-free. They were able to get a lot of leverage to do these trades. 1 cent suddenly turns into 100 or 1,000. Now, the problem with models is that all models are wrong and some models are dangerous. And when you have a model that tells you, hey, this trading is risk-free, therefore lever up as much as the banks will give you, it becomes a dangerous model because nothing is in fact risk-free, even though the model tells you so. And what happened here was what they thought, one thing they thought was supposed to go down, and then another thing they thought was supposed to come up, they were supposed to diverge, they started getting further and further apart. And so their shorts started losing because their shorts started getting higher in price. Their longs started losing because their longs started getting lower in price. Pretty soon, they got a margin call. But what happens when you're such a big player in these markets, you get a margin call, you have to liquidate your position. But they're such a big player that these shorts, what do you have to do to close out a short? You have to buy it to close. That's buying pressure. That drives the price higher. What do you have to do to close it along? You have to sell it. That drives the price down. And so by having to liquidate small portions of their trades and their positions, that made the rest of their positions worse. Paper losses started getting bigger and bigger and bigger. They had to start liquidating faster and faster and faster. Now, it got to a point where they started seeking help. They started seeking a bailout. They started calling banks. They called Bear Stearns. They called Warren Buffett, and they're like, hey, we need some help here because we're about to make some things really bad. We're about to break some financial markets here. We're going to cause some destruction. We need somebody to buy us out. Now, there was a deal on the table from Warren Buffett, and he said, I will buy the assets. He didn't want to buy everything, but there was a deal on the table from Warren Buffett, and they would have likely taken that deal. But the Federal Reserve, the Fed, came in and they said, you know what? No, we want to organize our own bailout. So they got all of the big guys on Wall Street, they got them all together and they said, you guys bail out long-term capital management. You buy the business and absorb the losses. You guys need to bail them out. Now, keep in mind, this is 1998. The Federal Reserve did not purchase anything. The Federal Reserve did not print any money to bail out long-term capital management. But they did organize a bailout for long-term capital management that was better than what the free market on its own had so far put together that they would have likely gone with. So you might look at this and think, well, that's not that big of a deal. That's pretty innocent, right? It was kind of a bailout, but they just organized it. They caused it to happen. They didn't print the money for it. They didn't buy anything, so it wasn't actually a Fed bailout. But there's an old saying, do not underestimate the day of small beginnings. And basically what that's saying is that just because something starts out very small, don't underestimate that. That could plant the seeds for that turning into something bigger and bigger later on. You plant a seed, turns into a tree later. So don't underestimate the day of small beginnings, and that was definitely a very small beginning for the Federal Reserve intervening in financial markets to stop failure. Now, one thing that is necessary to have free markets is failure. That is the core, it maybe not the core, but it is a core tenet of what capitalism is. If failure cannot happen, you do not have free markets. It is absolutely necessary. It is part of the definition. So what did that lead to? Well, it really just set precedents. So what happened a couple years later? Well, it was 1998 when this happened with long-term capital management. What else was going on at that time? The dot-com bubble. So when the dot-com bubble started to burst and started to unwind, what did the Federal Reserve do? They looked back and they said, we already have precedents for stepping in and softening the blow to make financial markets be able to absorb the pain a little bit easier. So what did they do to deal with the dot-com bubble bursting? They dropped interest rates. Again, they didn't buy any assets at that time. There was no big bailout. It was seemingly innocent. It was more than they did before for long-term capital management, but still, not a big deal, right? They just lowered interest rates a little bit to soften the blow. Well, that drop in interest rates caused a flood of money to be able to go into housing that would not have otherwise been able to do so, accelerated the malinvestment, misallocation of resources that was going into housing, turning into mortgage-backed securities and that whole mess. And so the way that the Federal Reserve dealt with long-term capital management gave precedence to allow them to deal with the dot-com bubble bursting, which fueled the fire for what they then had to do when the housing bubble collapsed and the great financial crisis started. And by this time, they can look back and they say, well, we already dropped rates when the dot-com bubble was bursting. We helped organize the bailout of long-term capital management. This time, it's all of Wall Street that's in trouble. So we can't just organize a bailout for themselves like we did for long-term capital management. We actually have to bail them out ourselves. We have to print the money to recapitalize their coffers. And again, at this point, you already have precedents for what you did before. So do not underestimate the day of small beginnings. And we all know it's probably less clear, but what they did during that time has continuously been planting the seeds for the way they had to deal with things starting in 2020. And it wasn't that long before they had to increase their quantitative easing after the financial crisis started because they tried to stop. Things got worse. They had to increase. And eventually it got to the point where in 2018, when they were trying to unwind it, there was a taper tantrum. And so they had to reverse course. And then in 2019, the repo market blew up. And by this time, now you've got a decade of precedents of intervening in financial markets and trying to control what happens. And it gets bigger and bigger each time, which sows the seeds for the next time. And it was just a couple of months later, early 2020, when things started to fall apart. And now, not only have you set precedents for helping it bail out a hedge fund, softening the blow on the economy, bailing out Wall Street, now you bail out the entire economy. So where does this go next? Well, number one, we know that it leads to something bigger and worse. Every time you intervene to soften the blow, to bail out, to stop failure, all that does is plant the seeds for a worse blow up next time. Second, we know that things scale up. It went from one hedge fund to the stock market, to Wall Street, to the entire economy. And by the looks of it, by the size, the sheer amount of government spending, the massive deficits, unprecedented government spending far in excess of what they're able to bring in revenue, the next bailout is going to have to be a government bailout where you have a merger of the central bank with the Treasury of monetary and fiscal policy, where you no longer have debt monetization, you just have full-on money printing as the source of government spending. We're not there yet, but I think it's coming soon. And so when all this is over, when people look back and read about it in the history books, I think the tipping point, the turning point, the point at which you could say this is the day capitalism started to die was the day that the Federal Reserve orchestrated the bailout of long-term capital management. And if you'd like to know more, I highly recommend the book, The Rise and Fall of Long-Term Capital Management. It's a fascinating read. I'll link it in the description below. As always, really appreciate you guys. Thanks so much for watching. Have a great day.